In this video, we're going to discuss bank certificate of deposits, otherwise known as bank CDs, and when the most optimal time to buy a CD is. A CD is really just a savings account. It's just a particular type of savings account. You're going to get monthly statements just like a regular savings account. You're going to open your account through the similar procedure as you would open a traditional savings account. But there are some key differences between a CD and a traditional savings account. First, the interest rate is fixed. So whenever you open the CD, the interest rate will be fixed for the entire term of the CD. Secondly, CDs have terms, and we'll talk about that in just a minute. Also, CDs have early withdrawal penalties or early termination fees. I have another video that goes into early withdrawal penalties in detail. This is not applicable to a traditional savings account. CDs do not allow any deposits or withdrawals after the opening of the account, which of course is different than a traditional savings account. CDs, also called term deposit accounts, have specific terms or months or years in which you cannot close the account or make any withdrawals until the end of the CD term. Traditional CDs have terms of 3 month, 6 month, 12 months, also 1 year, 2 year, 3 year, out to 5 years. Some banks even offer 7 year and 10 year terms, but traditional CDs are terms between 3 months and 5 years. So once you open the account cannot be closed without a penalty or any withdrawals or deposits made until the end of the term. So you're going to have to really think about how long you want to tie up these funds to maximize the yield of the account you open. People open CDs because typically you're going to receive a higher interest rate or a higher yield compared to a traditional savings account. If interest rates are expected to remain flat or go down in the future, it's probably a good time to open a CD. In this example, let's say I open a CD with a fixed 4% interest rate. So over the duration of my CD, the interest rate will always be 4%. Compared to, let's say, a savings account that at the time I open my CD has a yield of 3.5%. But because I expect interest rates to go down in the future, that 3.5% will continue to get lower and lower and lower over time. Thus, a CD is protecting me from a lowering interest rate environment. But there are risks to CDs. Let's say we're in a rising rate environment, and let's say, like my previous example, I open a 4% fixed rate CD. At the time I opened that CD, regular savings accounts were paying, let's say, 3%. But because I expect interest rates to rise over the term of my CD, what could happen is regular savings account rates become better than or higher than my CD interest rate. Because I have a fixed rate CD and I would incur early withdrawal penalty if I close my CD early, I'm stuck with a lower yielding account compared to if I just kept my money in a regular savings account. In summary, a CD is simply a different type of savings account. The main difference is it has a fixed interest rate and a term. And if I close my CD before the end of the term, I will receive a penalty. In lieu of these features, I generally will receive a higher yield, a higher interest rate than a regular savings account. I have 2 other videos that explain CDs in more detail if you would like to learn more. Thank you very much. And if you enjoy my content, please subscribe to my channel. I've got a lot of personal finance information available and more to come.